Welcome to the C-Suite series presented by Channel Check and Noble Capital Markets. Noble's an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on Channel Check. Today's interview features FAT Brands, NASDAQ ticker symbol FAT. Noble Senior Research Analyst Joe Gomes interviews FAT Brands President and CEO Andy Wiederhorn. Visit channelcheck.com or click the link in the description to access equity research, news, and advanced market data on FAT Brands, all at no cost. And now, here's Joe and Andy.
With us today is Andrew Wiederhorn, President and CEO of FAT Brands. Good morning, Andy, and thanks for taking the time to sit down with us.
Thank you for having me.
So, lots of changes in FAT Brands since we last spoke. Can you give us a rundown of the company's composition today? How many concepts, locations, system-wide sales, etc.?
You bet. We've grown by about 600% over the last 18 months. Today, we have 17 different restaurant brands, about 2,360 locations that are open amongst those 17 brands. And all but about 125 of those are franchised, so only 125 company-owned stores. We're doing business in 40 different countries around the world and 48 U.S. states. We should have system-wide sales of $2.2 billion in 2022. And we're just getting started. We've been very acquisitive, and we're integrating those acquisitions today and really focusing on growing our business.
That's lots of growth. And how are all the parts fitting together at FAT Brands? With all the new additions, how have you filled out the management team?
Well, so today we have the company organized into 4 categories. We have a QSR division, a fast casual division, a casual dining division, and then polished casual dining, which are the sports bars at Twin Peaks. And then in addition to that, we have our manufacturing operation in Atlanta, which has a plant that makes cookie dough and pretzel mix and things like that. So our management team today, senior management members make up about 20 people. And that team is very diverse. It comes from acquisitions that we've made where we've retained senior management or where we've added senior management members just from the marketplace in general. So we have different category presidents, 2 of them on the QSR side, 1 in fast casual, polished, et cetera, 1 in charge of the factory. And then, from the accounting and finance standpoint, global marketing operations, a very, very diverse and experienced senior management team from the restaurant industry today.
Excellent. And I've noticed that store sales have been improving sequentially from the depths of the COVID crisis. How much further do you need to go to get back to pre-COVID levels?
So for most of our brands, we are now above 2019 sales numbers and certainly above 2020 and 2021 numbers. So we're comping strongly positive across almost the entire system. The real issue probably for everyone is inflation and cost, not as much as comp today, because we're really seeing the traffic hold. Customers are coming back to the restaurants in droves, and they're frequently in the restaurants.
That's excellent news. And some of the innovations that came to the forefront during the COVID crisis was online ordering, home delivery, virtual kitchens, ghost kitchens. Can you take a minute and tell the audience how those efforts are working today?
Yeah, I think the most interesting change that we've seen across our different brands is that through the increase of third-party and direct delivery and that increased awareness during COVID, we've now, as customers have come back to the restaurants, we're continuing to see very strong delivery numbers. So overall sales are up because there's an increased awareness of that delivery option, even though customers are coming back into the restaurants. It's very positive, and it's been an additive effect. It wasn't a substitute one for the other. It's really increased overall sales. So I think that's something that we didn't expect, but we've been pleasantly surprised.
And what about the ghost kitchens? You still seeing a demand for those? How's that playing out?
So there's 2 different types of what I'll call ghost kitchens and virtual restaurants. We have more than 100 virtual restaurants, and that's where we're selling additional brands out of existing brick and mortar restaurants for delivery only. So you may have a Hurricane Grill and Wings that's selling Fatburger out of the kitchen and out of the back door in to-go packaging and be on the online ordering apps, and you can order a Fatburger in your area, but it's coming out of the kitchen from a Hurricane, which is fine. We bring in all the ingredients, bring in the packaging, and the kitchen crew has excess capacity to handle those incremental orders. That's been very successful. We have more than 100 of those up and running today, on our way to 200 domestically and several internationally. We have a few ghost kitchens. We've never been huge believers in ghost kitchens because I've always felt like, when 20 to 40% of the business is delivery and to go, you got to make up that other 60% some way, and that's brick and mortar customers coming into your restaurant or going through your drive-through. We are seeing some of those ghost kitchens do well, but many of them have multiple brands, and there's a lot of money to pay the landlord to be in those ghost kitchens. So we're not huge fans of them domestically. They seem to have worked quite well internationally. We have one franchise partner in the Middle East that's opening about 130 ghost kitchens with 5 or 6 of our brands, and they are in a very, very fast-paced development today with some 30 stores planned for the coming 12 months.
Now, one of the recurring themes these days, and you touched on it briefly, has been inflation and supply chain constraints. How are those impacting Fat Brands and/or your franchisees, and what steps has the company taken to minimize these impacts?
Yeah, we've definitely seen somewhere between 5 and 8% increases in costs across the system. Different categories have different issues. There's some alcohol increases. There's been chicken increases, and now chicken decreases. Beef prices are going up. Paper prices have gone up quite a bit. And the biggest, we've gone through, I feel like the snake has gone through the mouse has gone through the snake in terms of the crisis for supply chain running out of things. So we're not seeing shortages anymore as much as just cost increases. The only place where we see the real problem with availability is on the equipment side. A lot of refrigeration, freezers, fryers that are running behind schedule in terms of ordering them. Some of those come from overseas, some are made domestically. That slows down your new store openings a little bit because you're waiting for that refrigeration equipment or those fryers and things to get on premise. That's the biggest thing that we've seen that's slowing down a little bit of the development. As far as pure price increase, we've encouraged our franchisees to take price and maintain their margin, maintain their profitability everywhere they need to. You've never seen anyone lower prices after they take price. That's pretty unusual, but they've got to make up for that margin right now.
Can we talk a little bit about your franchisee base? How many of them have multiple concepts that they're franchising? Are you moving up the chain, so to speak, on the quality of your franchisees? How happy are you with the franchisee base?
The way we look at this business, the franchisee is our customer. It's not really the guy eating the chicken wings or the hamburgers or pizza or whatever they're eating. It's really the franchisee. That's who pays us a royalty every week, and it's critical to us that they make money and stay in business and build more restaurants and pay us more royalties. And something that's unique about Fat Brands, we have an 860 unit pipeline of additional stores paid for and signed up by our franchise partners to build those stores over the next 4 or 5 years. So that's another 150 units a year of incremental organic growth, which is very, very important. Those franchisees break out into 2 categories. It's about 350 of the 750 franchisees in our system today are multi-unit operators, anywhere from 2 to 75 units. There's only a couple that are in the 50s or 75s. Many of them are in the 5s and 10s. And so we really have the mom and pops operating one store here and there. And then we have these multi-unit operators that are very quickly continuing to build multiple brands of fat in their portfolio. So that's an interesting dynamic also, where they can build a management team with 1 to 5 stores or 10 stores at a particular brand, and then say, okay, my city or my area is full of Fatburger or Johnny Rockets, but I'd like another brand that I can infill into that same market. And that's been an opportunity for us to cross-sell.
So you talked about the organic growth in the number of units, 150 units maybe on an annual basis. How does that impact Fat Brands per se?
So we think that by the end of 2022, we'll have an EBITDA run rate of somewhere in a low $90 million range, whether it's 90 or 95, depends probably on inflation and things like that for now, and also how fast we integrate the brands we've acquired. But that incremental growth of 125 to 150 stores a year is another $10 million a year of EBITDA. So that's a potential to grow our unit count by 860 stores. That's 33% growth in unit count from 2,360 to adding another 860. And then in EBITDA, it's another $50 million. It's another $10 million a year of incremental organic growth. And that's really why we hit the pause button a little bit on acquisition side and said, we need to digest what we've acquired. And we have this huge amount of built up organic growth we need to execute on. Let's get those new stores open, because that adds that 10 million a year of EBITDA growth at no cost to us. It's free versus going out and borrowing more money to buy another brand. This is a very good way to de-lever and to organically grow our EBITDA.
Now, you mentioned acquisition. You were very acquisitive last year. I assume you're not done on the inorganic growth side. Do you see a preference for more tuck-in acquisitions, or do you see additional transformative acquisitions in Fat Brand's future?
Well, we are looking at everything. We always have a bid for something that makes sense. But tuck-in acquisitions are really very interesting to us today, where we can add, for example, more manufacturing for our manufacturing facility. At the same time, we add a complementary brand. Like we buy another cookie brand, we get to make the cookie dough, and we get the royalties on the cookies. Things like that, where we're sort of getting two bites at the apple. Those are very strategic and interesting to us. I think that you'll see a few of those during the rest of 2022. I don't think there'll be any transformative acquisitions. I think that we want to see the capital markets calm down a little bit and get our debt rated and refinanced, which we can talk about. And then I think you'll see us make some more transformative acquisitions after that.
You mentioned the manufacturing facility, and I think that's a hidden gem in the Fat Brands portfolio. Can you talk about how you're going to improve the utilization at the facility and what that can mean to the company?
You bet. So the factory manufactures around $40 million a year in product. That's cookie dough and pretzel mix today. And it makes about $15 million a year. So it's very profitable. And of that 90 to 95 million in EBITDA, approximately 15 million of that's coming from the factory. The factory's only running at about 33% capacity because it's only running one shift a day. We could run an evening shift and a graveyard shift and have twice the capacity on top of the 1/3 that we're running now. So there's a lot of room there to manufacture more product. Even if it's on a contract manufacturing basis for other brands that want to buy product, we can supply them. So that's a big focus for us for the rest of 2022 and 2023 is to increase the utilization of the factory. And look, if we've said this before, when you look at our debt levels and the long-term financing we have in place, we've got lots of excess cash flow and debt service coverage, to have a good cushion there. But that factory is a gem. That factory at 70 or 80% capacity could also fetch a pretty big number in the marketplace if we ever needed to delever or pay down debt. So it's really a good option for us.
So multiple streams of abilities to increase EBITDA without having to do additional acquisitions, which is fantastic. Now, you've utilized the whole business securitization facilities to finance the acquisitive growth. Can you walk us through what these are and how Fat Brands can use these for further growth? And maybe talk a little bit why the company's seeking to get the facilities rated and what that could mean to Fat Brands?
You bet. So we have 4 different outstanding securitization trusts in the market today. They total about $945 million. We use all of those facilities to make incremental acquisitions during 2020 and 2021, such as buying Global Franchise Group, buying Twin Peaks, buying Native Grill and Wings, buying Fazoli's, and even buying Johnny Rockets back in 2020. Each of those are in 4 different silos, if you will, different bond offerings from anywhere from 145 million up to 350 million. And each of those deals are just secured by the brands that we acquired at that time or that we refinanced at that time. So they're separately pledged to each trust. They're non-recourse. It's non-recourse financing, which is very interesting from a risk management perspective. And Fat Brand serves as the manager and sponsor of those trusts. Now, we issued those bonds on an unrated basis, sort of in a hurry to make the acquisitions on a timely basis, which means they don't have a triple B rating or a double B rating or single A rating on them. They have no rating. And that means we're paying a slightly higher rate to investors. If we call those bonds and we reissue them with an investment grade rating, it will significantly lower our borrowing costs, even in today's upward interest rate moving environment. So we think we can save anywhere from 1.5% to 3%, maybe even more, from refinancing our debt on a rated basis and then reissuing it. It's 30-year debt as it is today, so we have lots of runway here, but the rates start to go up in another year and the amortization starts to kick in another year. So we got a lot of cushion here to get these deals rated and reissued, and we're starting that process now. So
another way to increase cash flow to the company. It's excellent.
And yeah, you could see it. Sorry, you could see us, with on 950 million. If you save 2%, that's $20 million of free cash flow. It just drops to the bottom line. So it's a very meaningful way, in addition to organic growth and growing the factory, is getting that debt rated and reissued. We just save a ton of cash.
And where are you in the process of that re-rating?
We're fully engaged with our investment banks to take the historical data from the performance of the brands that we've acquired and meet with the rating agencies and go through that process. We've been rated before. We went into 2020 with a rating from DBRS Morningstar, and we're going back into the market now to talk about which rating agency we pick, which horse do you ride to get your rating done and then get back out in the market. I expect that in Q3 we'll complete at least one of the rated deals in terms of calling it and reissuing it, and hopefully by the end of Q4 we get all 4 of the deals called and reissued.
We'll look forward to that. Now, as part of the acquisitions last year, you issued some preferred shares that are now coming due. How are you planning on paying those off?
Yeah, 2 ways. We have in our existing securitization facilities a lot of excess capacity. In the first deal, which is called FAT 2021, that's the deal that has Johnny Rockets, Fatburger, Elevation Burger, Hurricane Grill and Wings, Buffalo's Cafe, some of our legacy brands. There's a lot of excess capacity in that transaction alone, where we could borrow another $75 million or so. And we're planning to issue bonds under that facility to redeem some of that $135 million of preferred stock. And I expect that we'll get that done by the end of Q2. And then in our global franchise group deal, that's the Round Table Pizza, Marble Slab Ice Cream, Great American Cookie, Hot Dog on a Stick, Pretzelmaker deal that we bought last summer. That's eligible to be called in July of this summer. So I expect that sometime as we go through the ratings process, we will either call that deal and reissue with a slightly higher dollar level, and we'll use the balance of those proceeds, probably another $100 million, to redeem the rest of the preferred that was issued in connection with those acquisitions, cleaning up essentially that $135 million of preferred. We could do that as a separate facility, a separate what they call a tap facility, where you tap your securitization to borrow a little more, like we're doing right now on the FAT 2021 deal to make the first redemption. But it all has to do with the timing of when you can call the bonds and reissue. They have like 1 year no call provisions. So we may draw down sooner just to redeem the preferred, but we're in the middle of that process now. And we save money by doing that. The effective cost of the preferred is higher than the cost of the securitization debt. So if we're going to redeem it anyway, whether we draw down on the tap facility or we call and reissue, either one of them is less expensive than the preferred. So it's a great way to buy back that preferred and to save on the preferred dividend expense, essentially trading that for a lower interest rate expense.
And do you have any other avenues of financing for growth or for redeeming some of these issues that are coming due that you can tap?
Yeah, so we have a $480 million shelf filing that's effective with the SEC. We can either use common stock, we could issue new preferred shares if we wanted to raise capital, if we have to redeem the old shares, or to call and reissue on the securitization facility. So we have a lot of flexibility in terms of how much we could issue and which lever we would pull. But it seems like the least expensive piece of paper to write is the securitization trust facility paper today for redeeming preferred. But that could change if the equity markets are kind to us as we produce the earnings that we promised everyone.
So that kind of leads into my next question. As the largest shareholder, one would believe you'd like to see a higher stock price. In your view, what does FAT Brands have to do or accomplish in order to attract that investor interest to drive that price higher?
Yeah, certainly no one is happy to see the restaurant sector sell off by 30 or 40% here over the last few months. And, given the economy, that's been annoying. I think for FAT Brands, for us, we just have to do what we said we were going to do. We put up a $15 million EBITDA quarter for Q1 on the heels of a $10 million EBITDA quarter for Q4. We expect to have a very strong Q2 EBITDA quarter, and that will incrementally show the growth and the integration of the brands that we've acquired. So I think that proving out that $90+ million run rate of EBITDA will give investors a lot of comfort that, okay, they finally got up to that level where we're at a cruising altitude, where that EBITDA is happening from the integration and the synergies that we've been able to wring out from the excess overhead elimination of the brands we've acquired. And I think that will really help lift the stock price. You're always worried about float and wanting to have a little bit more float, not really at a $6 or $7 price, of course, at a $12 price or, whatever the number is, it makes more sense. But of course, we're, aspirational that if you think about how the valuations are today, you've got the S&P trading at 16 times something, FAT is trading in the 12s and really should be trading up in the 16s. And if it was, it would be up in the $25 range for stock price. price. So we think there's a lot of room to grow. We think we're undervalued relative to the comp set of other restaurant franchising companies, let alone burgers or pizza or whatever. And so just a lot of opportunity there. And we just have to execute on what we promised everyone.
So I'm going to throw it to you. What is the elevator pitch to investors for Fat Brands?
Yeah, I think really for us, this is an undervalued play. We have a strong dividend. We've been consistent with paying that dividend. It has a great yield on it today at over a 9% yield on our 52 cents a year, 13 cents a share, a quarter on the common stock dividend. We also have this 8.25% preferred. So they're both paying, really good regular dividend. We're going to build out our manufacturing operation, that factory, which is extra organic growth incrementally. We're going to build out our pipeline of new stores, again, which is another 10 million a year of organic growth. And we're going to continue to integrate and reap the synergies from these acquisitions we made, as well as refinancing our debt, as we've talked about. So it's really a focus on those 4 or 5 objectives. It's not so much, particular dollar amount or percentage change or this or that. It's really just executing on those strategic goals that I think is going to see, the results come to a significant increase in our stock price.
That's an exciting pitch. Well, Andy, we covered a lot of ground today, got some significant insight into what Fat Brands does, its markets, opportunities. We appreciate you taking the time to do this CEO interview, and we wish you and the company the best in the future. Thanks again.
Thanks so much for having me.
Thank you for joining us for this C-Suite interview presentation brought to you by Channel Check. View our YouTube channel for more video content, including C-Suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelcheck.com or click the link in the description to access equity research, news, and advanced market data on this and the 6,000 other small and micro-cap companies listed.